And so September begins with the markets falling apart everywhere, and it's oil that we have to blame. Apparently, but there's perhaps more than meets the eye here. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And the cracks in the global economy are certainly showing themselves as we come back from the U.S. Labor Day holiday in financial markets. Everybody kind of falling out of bed here. Stocks lower everywhere, bond yields higher everywhere, and the idea seemingly that we are in a situation where Saudi Arabia is going to stick with its output production and shipment cuts through the end of the year, and that what this is going to be is inflationary because oil prices are going to respond and have been responding by surging. And so what we'll have is, at the very least, central banks unable to cut. Never mind, perhaps, the possibility that they might restart hiking, but at the very least that that they'll be unable to cut rates, which of course brings us to the key question. Why suddenly do markets care where they weren't really paying attention to this before? And the idea seems to be that the risk of a global recession is much more present now, as we've argued here before ad nauseum on Macro Money. And so the level of resilience that markets have in the face of these kinds of pieces of news flow has been significantly diminished. That when Saudi Arabia and Russia and their OPEC plus allies were banging a drum about reducing output a year and a half ago, nobody really seemed to pay particular attention because they've never really been able to organize themselves sufficiently to actually deliver on those things. But what we seem to be having here is a much stronger market response, born less of these oil producers actually finding a way to have coordinated production cuts. That's still very much unlikely, but maybe Saudi can manage something themselves. Rather, it seems like the market is just prepared to worry about things because the level of defense against such things actually mattering has been worn down terribly. Which brings us to what may be happening in these markets in as little as 24 hours. Because this week, it seems all of the big event risk is clustered on Wednesday, just as the cracks in global growth appear to deepen. And so what we're going to do here is we're going to talk about what's coming up next. We have to set the stage here by quickly going over what has occurred just at the start of this week and the month in earnest here. But we're going to look at what's next and how that might fit into this entire picture, what it all might mean as the sell-off appears to gather conviction. We begin with a monetary policy announcement from the Bank of Canada. And generally speaking, this seems uncontroversial. They're not expected to raise rates, a mere 9% chance of any kind of a change, and that change seen as maybe the possibility of a cut. Obviously, that's not really on the menu here. We can see the likelihood is a mere 2 basis points that's priced in, so almost certainly nobody is going anywhere here. The implied rate 5.008 and the target rate currently 5. So the expectation is that absolutely nothing is happening here with Canadian rates. If we look down and along the expected trajectory that's priced into the markets here, we can see there's about a 30% chance that we get a hike in October. That starts to fade by the beginning of next year, and we start to get into about a 60% chance for a cut occurring somewhere June or July. So that's where things really start to come together, and it looks like it's about an even shot, about a 30% chance either or, and a cumulative 21 basis points already baked in. So that's about where we're at the moment. So if we consider this at face value, there's seemingly nothing to see here. But this is actually tremendously important, not so much in what the Bank of Canada might do, but in what the Bank of Canada might say. So if we look at the path for Canadian policy, something that's striking is that it's really taken a big leg lower toward a flatter outlook just over the past week. We can see here that the yield curve is not very significantly changed relative to where the last Bank of Canada meeting was, which was about mid-July. But as compared to last week, and in particular in the back end of the curve, 6-month, 1 year, 2 year outlook, we're looking a lot lower this week than we did last week. And much of this has to do with the very disappointing second quarter GDP number that we got out of Canada last week. The expectation was that we were going to get growth north of 1%. What we actually got was a contraction of 0.2%. This is actually very important. Looking at the breakdown in that GDP release, what we see when we bucket GDP into two big sections: domestic demand, so in other words, what the economy is doing at home, so people in Canada buying and selling things, business activity inside of Canada, and external demand, so the net balance of imports and exports. And what we find is that it is the external sector that really hurt when it comes to growth in the second quarter. If we look at what this actually lines up looking like, we see that domestic demand in Canada actually contributed over 1% to growth in the second quarter. The trouble is that the external sector shaved off 1.2%. And so what we ended up with was a net 0.2% decline. Now, this should be worrying. And it should be worrying because Canada's external sector is overwhelmingly tuned to the U.S. I took a look all the way back to 1997 here, and we can see that from the peak in this slice of time here, back in the early 2000s, to the COVID bottom, to now, the range of Canadian exports, the share of Canadian exports that have gone to the U.S. has gone from 85% to 65% to now 78%. All of which is to say, at no point through all of what's happened, the dot-com bust, the Great Recession, the COVID pandemic, everything in the middle with the Trump administration tearing up NAFTA and renegotiating it, all of the various things that might have impacted this, at no point did we have a situation where a huge share of Canada's exports didn't go to the U.S. And it wasn't very tied into U.S. demand for what's happening in Canada's own business cycle. And so when we see this here, and the expectation is that we were going to get about 1% growth, and we did get it domestically. It's just on the external front, between weak exports of goods and building inventories, we ended up with a 1.2% down influence from the external side. When we see that kind of thing and we consider what that external demand is, you start to say, well, if external demand is down this much, where does external demand come from? Well, it comes from the U.S. overwhelmingly. That much is clear. So what does this say about the U.S. economy? Nothing positive, it would seem. And so just as we might be very interested to hear what the Reserve Bank of Australia says about demand in China, because that economy is intimately linked with demand from China. And indeed, they had a meeting overnight. They said the scary things that people were afraid to hear about the central bank starting to worry about what's going on in China. And we saw the Australian dollar crater. Even as the central bank said, well, look, inflation is not beaten, we may yet need to raise rates. That really didn't seem to convince anyone. So, too, when we look at what the Bank of Canada might say, the key is perhaps less what they actually intend to do on rates, but more what they might say about what's going on with U.S. demand and how that's showing up in Canadian economic dynamics. Because what this could be is a very early view on contagion from a U.S. slowdown starting to spread. We, of course, know that the U.S. economy has been slowing. We know that that's exactly what the Fed had in mind. But what we've managed to achieve so far is that even though the economies of Europe and China, the other two major engines of global growth, are obviously in a very, very dire state, and we'll talk about that momentarily here, the U.S. has been relatively resilient, and that's been what's been holding up global growth. If this is weakness in the U.S., thanks to the Fed's actions, that's now starting to cross borders, then perhaps that last line of defense is giving way. On the same day, and indeed happening at the exact same time, we are going to have the release of ISM Service Sector Purchasing Manager Index data. This is similar to the S&P Global PMIs, only this one uses the same general methodology to come from the Institute of Supply Management, hence ISM. And you can see here that what's expected here is a modest cooling in service sector activity growth, that index ticking down here, according to expectations, to 52.5. Now, we can see here that manufacturing in the U.S., that's the other index that you see here, that's been in contraction mode at least since mid-year. And you can tell that because, of course, this works like a PMI survey would, where 50 is the center line, above 50 is growth, below 50 is contraction. Anything deeper below 50, the further it goes under 50, the faster the contraction, the further it goes above, the faster the expansion. And of course, you can see here manufacturing has been below 50 since at least mid-year last year. Now, that basically means that we're looking at over a year at this point of contracting manufacturing. And this is something that we've seen really out of most major economies and mostly reflects central bank tightening and the slowing of economic activity that followed. Service sectors have been a little bit more resilient, but have started to come apart as well as some of the lingering after effects after COVID started to wane. So stimulus money that was left over as lockdowns ended, that started to get spent down and fade. Latent demand for things that people couldn't participate in, like restaurants and outdoor entertainment and travel. Pent-up demand there toward the end of last year and going into this year seemed to lift services in most areas. That seems to have started to unravel. But what we see here is that if we hold to these numbers as they are expected here or something close, we'll still have service sector activity growth about like what we've seen it as through much of this year. Down, not great, but still generally kind of oscillating in this sort of 55 to 50 range on the ISM index. So positive, not fast, but reasonable. This, of course, is something that presents a very significant concern if it means that the Fed can't cut rates. As we've just talked about, one of the main issues here seems to be, at least today, a surge in the price of oil and an upshift in global yields that subsequently spooks the markets because perhaps then central banks can't cut to actually have some kind of a relief valve to all of this economic weakness. Well, if we get resilience in the service sector at a time when everything else is hurting, that probably means the Fed is in no position to offer that relief valve. So we can go back here and see from the latest set of inflation numbers. This is, of course, the PCE index that we got last week. We could just as well look at CPI, and it will show exactly the same thing. But we'll focus on this. It's the more recent release, and it is the Fed's favorite inflation gauge. We can see here goods are now an actual disinflationary force. All of the inflation still seems to be in services. And when we look at services, the biggest contributor there is housing services, so upkeep on owner-occupied housing, most importantly. But there's not really very much that the Fed can do about that with rate hikes. They certainly can't displace people out of homes or lower housing prices or lower the sticker price for upkeeping homes at a time when mortgage rates outstanding in the market available 7.6%, but the rate on most mortgage debt outstanding, so those mortgages already out there, 3.6%. Not surprisingly, people out there don't want to sell homes, so inventories are low, so the price is high. They also want to do everything they can to stay in their home so they don't have to refinance, so upkeep costs, not surprisingly, also high. Not a whole lot the Fed can do about that with rates policy. So then the focus shifts to the other thing that the Fed can do, which is slow labor market demand, where sticky wages have been the other big contributor to lingering inflation. Most of employment in the U.S. occurs in the service sector. So if the service sector holds up reasonably well here, well, then the Fed can't cut, ostensibly. And indeed, we can see here, if we look at what's been going on with inflation relative to the employment cost index, that's the yellow line there, the ECI, we can see that that employment cost index has not fallen nearly to the extent that CPI and PCE have. CPI down from 9.1 to 3.2, PCE down from 7 to 3.3. Big swings there of more than half in each case. In the case of the employment cost index, we're down from 5.1 to 4.5, less than 1%. And if you look at how that looks compared to how the core inflation number here for PCE looks, how stable it is at 4.2 relative to where it was even back in 2021, and you look at how the employment cost index looks, you start to see these are perhaps showing you the same thing. So from the Fed's perspective, a strong service sector is every reason not to cut, which of course presents an issue when you look in parallel with perhaps signs out of Canada that U.S. demand is already weakening and the global economy outside of the U.S. is doing much worse. We're going to get more evidence on that, again, same day, although not the same time, from Chinese import-export numbers. And here, of course, we've had a precipitous decline in both domestic and external demand. In this case, both are expected to be down 9% year on year, but Chinese economic data has tended to underperform relative to forecasts, even recently, where you can see that index has shifted up a little bit. So when this economic surprise index is in negative territory, that means data tends to underperform versus forecasts as opposed to outperform. That's when it's above zero. You can see it's become a little bit less negative, but that's not really anything to smile about, because what that's owed to mostly is the expectations being brought down. So if we look at baseline expectations for Chinese GDP growth, for example, they've been ratcheted down tremendously from about the same period in mid-July onward to where this rebound happens. So Chinese economic data still tending to surprise on the downside, and the only real difference has been the margin by which that happens, and that's because people's expectations have been brought down, not because the data has become any better. So the situation still looking dire, still looking like it might show further evidence that China's economy is sinking deeper and deeper into the mud. They attempted to announce a stimulus effort to this point over the weekend to try to buoy the property sector, the place where the pain has been most acute. And that landed with a thud. Absolutely no positive reaction from markets to speak of. There was a brief pop in Chinese shares amid the illiquidity while the U.S. was off on holiday, but none of it has lasted. It's very quickly unraveled. And of course, any related assets like the Australian dollar, we've just mentioned, has been taken to the woodshed. So clearly, the markets don't have confidence that this is going to work. So let's put this together. The Eurozone, just looking at the latest set of PMI numbers, and they were just revised here overnight for the latest set of figures to look even more abysmal than it looked when they were first released. The Eurozone is all but certainly in recession at this point. China can't seem to do anything to revive growth, or at least the things that they're doing aren't working, and the economy is coming undone. The last bastion of growth and of resilience here was the U.S. From the looks of things, we've caught ourselves in a bit of a difficult situation there, where if the service sector still looks like it's holding up, meanwhile, the Fed is taking square aim at it, and signs of weakening are already occurring, perhaps as telegraphed in Canada's data and perhaps as highlighted by the Bank of Canada in these next 24 hours, then we're in a situation where that last leg of resilience is already falling out, but the Fed isn't going to do anything about it. In fact, they're going to be hamstrung in providing stimulus to counter this, because they're still fighting an inflation fight in a sticky labor market where services is holding up just enough to keep inflation from going down and toward the Fed's target. That, of course, leaves us with 57% of the global GDP pie in a bad space, and actually it's more, because the 43 that's rest of world here intimately connects with the former three, because much of the demand that those rest of world economies need for them to have growth comes from them being vendors to the three large ones. Think, again, Canada and the US, Australia and China, or Central European countries and the Eurozone. So we are seemingly starting to see the cracks in global growth widen and the fissures deepen. The markets are also showing that they are already beginning to respond. If we take a look at how the S&P has been doing here most recently, the striking bit is that stocks have been going down as Fed rate hike odds have narrowed. So we can see here that this spread between September and December 2023 Fed funds futures showing us scope for another rate hike from the Fed this year. It's recovered from these heady, dovish settings, and stocks were able to recover with it largely because much of this was the banking crisis being contained and the debt ceiling debacle being unwound. What's happened basically since July, once all of those things came off the board, is standstill in policy expectations and the ability for stocks to levitate somewhat through that. It started to make sense that stocks came off, perhaps, as rate hike odds began to build. But what's really scary here is that stocks are now coming down as there is less of a scope for that tightening. What this implies is that the markets are starting to worry that it isn't rate hikes that are going to hurt stocks. It's the recession that those rate hikes that have already occurred has already set in motion. We see something very similar with the US dollar. We've talked, of course, about the dollar being usually the beneficiary of liquidation when markets get defensive. And what we see here is that it's been rallying aggressively even as rate hike expectations ease. So the yield-based support for the dollar has somewhat weakened. All the same, it's been rallying, seemingly suggesting that what's going on here isn't so much precipitated by the kind of defensive stock and currency market dynamics that we saw last year and earlier this year, where anything meaning a tighter Fed was bad for risk and good for the dollar, and a looser Fed was good for risk and bad for the dollar, that now it's gone the other way. Global growth has become scary enough that rate cut expectations may start to give way to rate hike expectations. But not only is that not good news, but stocks are falling in tandem and the dollar is rallying. Meaning the concern has become less the near-term impact of Fed policy and more what has Fed policy that's already occurred and other central bank tightening that's already occurred done to global growth already. And as we start to see these delayed impacts take hold, how bad of a recession are we in store for already, as opposed to what might be coming next from this policy official or that policy official or this central bank or that one. And that is macro money for today. As ever, we are here Monday through Thursday, not this week because we had Monday off for the Labor Day holiday, but we'll be back to our regular scheduled programming from here. We convene right after Overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, talking about each day's events after the Wall Street close and trying to figure out what may follow thereafter. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on Twitter at Ilya Spivak. Thanks very much for joining. See you tomorrow.